All right. Hello, everyone. I don't know, some of you it may be morning, evening. Today's session is on Prada's Hong Kong IPO. It's an IPO that took place in 2011. I think most of you, if not all of you, know at least some of the Prada products, perhaps less about the IPO. So that's what we're going to talk about today. This is part of usually part of the course. Usually present this case, use this case, which I wrote with a colleague, usually present it and use it in different programs, in particular the Executive Master in Finance here at HEC Paris. It follows usually some training on company valuation, on company restructuring. So we'll touch on some of these topics without going totally deep into those. We'll go, of course, much deeper if we had more time to do so. The plan of attack essentially is going to talk a little bit about Prada. I'll go fast on that. Usually I would spend more time because I don't like doing, in fact, that we cannot do corporate finance in thin air. We'd like to know what the business is about, who are the customers, what are the products, and so on. Today we'll be a bit fast on that. We'll go then to the reasons for doing an IPO, initial public offering, and in particular, why Prada in particular chose to do its IPO, why in Hong Kong. Then we'll spend a bit of time on the pricing of the IPO. This is talking to the different techniques for valuing a company, and in particular, valuing a company in an IPO context. I'll touch a little bit on those techniques, at least to give an intro to that. And then eventually I'll talk about the process through which Prada went public, and more broadly, of course, how companies go public in general. So to get started, let me talk a little bit about Prada. Just a brief history of the company. It was started in 1913 in Italy, in Milan. Really, at the time, it was just one shop, one store. The founder of the company is actually the grandfather of the current heiress to the company, Miuccia Prada. So Mario Prada opens his first store in Milan. It's a luxury goods store, mostly leather goods stores, luggage and so on. Then fast forward to the late 70s, where Maria, Miuccia, in fact nicknamed not only Miuccia but Miu Miu, Maria Prada takes over the family business. At the time, the company was kind of struggling, and she takes over the business. She has an interesting life before that, but she becomes the boss of the company. She's joined by a leather goods entrepreneur, Patrizio Bertelli, who very soon becomes also her husband, as well as business partner, and they essentially shape the company into what it is today. The 80s, first international hits with the company, essentially handbags sold in luxury stores around the world, very big success. Eventually, Prada starts opening its own stores. As we will see, this is a very important aspect of the business. Prada starts its first women's collection, so ready-to-wear collection, also in the late 80s. Moving forward, very important year for the group. Miu Miu, the second major brand of the company, is created, obviously named after Miuccia Prada. Starts its first women's collection, so it's a ready-to-wear brand, and then Prada starts its first men's collection. So they've moved away from, not necessarily away, but they've added to leather goods. They've added now ready-to-wear and two super brands, Prada and now the new brand Miu Miu. Late 90s, this is really a turning point for the company. The company changes gears completely. It goes on an acquisition spree. If you read any article about Prada at that period, they all use the same joke. They go on a buying spree, and they start buying a bunch of other labels: Helmut Lang, Jill Sander, Fendi, Churches, and Car Shoe. As we will see, many of those acquisitions actually failed in the sense that they were not integrated. The companies didn't do well, and eventually Prada, the group Prada, sold most of these companies except for churches and car shoe. The result of that buying spree is not only that the acquisitions failed, the integration failed essentially, but the company was left with a high debt burden. Early 2000s, in reaction to that high debt burden, the company tries to do an IPO, in fact not one, but 2 IPOs, and both attempts fail, essentially because of 9/11. Very, very bad timing. 2007, 2008, again, 2 new IPO attempts, 2 new failures, this time because of the financial crisis. Terrible timing. The company decides to stop trying to do an IPO and instead goes on an expansion phase, but not by acquiring companies, but by growing its existing brands. 2011, this is when the case is set, March 2011. The company now decides to do a new IPO. The plan started at the very end of 2010, and by March 2011, the plans are well underway. The IPO is going to take place in June, unless something happens between now and June. Very briefly, the 4 brands that the Prada Group owns, it's refocused on just 4 brands. This is very, very unusual. Prada started, of course, with this one brand, the Prada brand, which is now developed from leather goods all the way to eyewear and fragrances. Of course, eyewear and fragrances are not produced by Prada itself. They are licensed out. But leather goods, ready-to-wear, footwear, this is totally associated with Prada. What is more surprising is that they've managed to develop from scratch a second super brand, Miu Miu, which is a little bit more edgy, a little bit more for a younger clientele. They also have 2 other brands, Churches, which is an old English company, British company in Northampton, set in Northampton in England, and they're doing very high quality, very high branding shoes, footwear, I should say. And then car shoe, this is perhaps the most unusual brand. They develop essentially driving shoes. This is what I've put on the slide. These are shoes with little grips underneath, supposedly for driving. They've also branched out into leather goods more broadly. Okay, as I said, I'm going to go very fast on the business itself. Let me move to just a couple of very important themes for Prada. And these themes, by the way, are also very relevant for other luxury good companies, Western luxury good companies. First theme, the distribution channels. Initially, Prada used, of course, other department stores to distribute its products, so the wholesale distribution channel, but it's moved, like many luxury companies, it's moved towards owning its own stores. Directly owned stores, this is a very important aspect of the business, mostly because Prada wants to control both the image, the brand image that it projects, and the pricing. Second very big theme, it's a related theme, by the way, international presence. As you can see, the sales are spread all around the world. One thing I want to point out is that the sales in Europe are really a bit inflated because a large fraction of those sales in Europe are in fact to Asian tourists in Europe, and in particular to Chinese tourists in Europe. So China and the Chinese market, absolutely key for Prada as well as for other luxury companies. The reason why these 2 things are connected is that Prada is in fact lagging its main competitors, LVMH and the like, in going to China and also in developing its network of directly owned stores. So that's one of the themes, very important strategic themes for Prada, catching up with its rivals. Okay, let me leave it at that for now. As far as the business is concerned, there will be many other things to talk about. But since we're going to talk about finance mostly, let me move to the rationale for an IPO. Let me start generally. What's the ownership structure of Prada, the Prada Group? This looks very complex. In fact, it's not as complex as it looks. All the branches on the top go to 4 individuals, essentially the Prada family and Patrizio Bertelli, who's the husband of Miuccia Prada. So let me summarize this as the Prada family, through various companies, set up mostly for tax and for tax optimization and inheritance optimization. They own a holding, the Prada holding company, that itself owns 95% of Prada SPA. Prada SPA is the operating company where all of the assets are, the production facilities, the brands, and so on. People, of course. There's another shareholder, just one other shareholder. It's a bank. Intesa Sanpaolo, this is a bank that owns about 5% of the equity in Prada SPA. And just for the anecdote, they own this 5% because when Prada was, did its acquisition spree and found itself very indebted, they had to pay the bank, and one settlement with the bank was to give them some equity in the company. That's how they became shareholders. All right, so to summarize, the Prada family owns 95% of the company. The bank owns the remaining 5%. Of course, Prada SPA has some debt, about €500 million in debt. The holding company has its own debt, about 600 million, I believe. So altogether, about $1 billion in debt. Okay, why go public? So let me talk generally about why companies go public. Perhaps to organize, it's good to organize one's mind about the topic. There's essentially 3 reasons. There's really 2 reasons and 1 side effect. The first possible reason for going public is that the company actually needs money. And of course, going public can provide funds to the company to be used for investment, to be used to pay down the debt, and so on. And at the time of the IPO, this is done, and note this, and this is important, by issuing new shares. In other words, Prada SPA at the IPO can create and sell new shares to new investors, in which case the cash that these investors pay for buying these so-called primary shares or new shares goes into the treasury of the company. The IPO can, of course, facilitate raising funds for the company later on as well after the IPO, because now the shares are traded, they're liquid, more shares can be sold, banks may be more ready to lend to a company once its stock is publicly traded, and so on. Of course, companies can use their own shares as a currency to acquire other companies, and this is a way of financing acquisitions, essentially. That's the first reason, so bear this in mind, money for the company. Second possible reason, money for the owners. How does this work? Well, at the time of the IPO, the owners of the company, in this case, the Prada family mostly, and a little bit the bank, can sell existing shares, sell their own shares in Prada SPA, sell them to new investors. In that case, these shares are called secondary shares. They already exist, they're already owned by some shareholders, and they are sold to new investors. The only difference between the two cases is that in that case, if let's say the Prada family sells some of the shares it owns in the operating company, the funds raised, the proceeds from those sales, from the sale, go to the Prada family itself. In this case, of course, to the holding company that represents the Prada family. Okay, not to the company. Again, later on, the same owners, once the company is public, it's easier for them to raise money, either by selling more shares, borrowing against the shares that they still hold, etc., etc. Third rationale for an IPO, it's not really a reason why companies go public most of the time, but it's oftentimes a side effect of going public, and a very important one, is that going from being a private company in the sense that the shares are not traded on a stock exchange, to being a publicly traded company usually has an impact on the business. Suppliers, customers, consider you differently. The IPO has a marketing effect. That's probably the case for Prada. You can pay your employees with shares, incentivize them differently, etc., etc. Again, this is usually not the main reason for going public, but that's a side effect of going public. Now, all these 3 points you need to bear in mind. These are general points. We need to think about what's the case, what's most important in the specific case of Prada. Now, this is an exercise that I don't think you could do on your own, but this is an exercise that we go through in class usually. It's just to forecast the funding needs of Prada. And to do so, we take the business plan that Prada has to provide as part of the IPO documentation, and we check how much money they think they need in the next few years. And here's what we find. For the next 3 years, looking first at the uses of funds, where Prada is going to spend its money, mostly capital expenditures, a bit increasing working capital, basically letting its customers pay later, etc. Stocks, very important for Prada. This is a cost, building up stocks. The total uses are around 300 million, 350 million euros per year. Now let's think about the sources. This is a very rough calculation. We could do much better than this, but this gives us a ballpark number. For the sources, we have net income, which is the accounting measure of profits. And I've added here just depreciation because depreciation is a non-cash item. It's not really an expense. The real expense that corresponds to depreciation is capital expenditures. So in terms of sources, in terms of inflow of cash, it's around 500, 600, 700 million euros per year. In other words, every year for the next 3 years, Prada is going to be in the positive once it has funded all of its costs, about 200, 250, 400 million euros per year. In the last line, which I've highlighted, I've cumulated these numbers. It means after 3 years, Prada will have close to €1 billion in surplus, billion euros in surplus. Okay, I think I've made my case. This company does not need any money, at least by its own projections. So it's really not a case for raising money for the company. It's a case of the owners wanting to cash out, at least to some extent. We'll see that this will play out in the IPO. Now, I've prepared a little poll for you, just to keep you on your toes a little bit. Now, since we have established that the company, Prada, does not need money, and therefore that's not the reason for the IPO, is the IPO going to be mostly, or should the IPO be mostly an IPO with primary shares, secondary shares, or perhaps both? If you can answer the poll quickly, we'll take it from there.
Sure, the poll is now open. We'll leave it open for a few more seconds. All right, closing the poll now. So Denis, these are the results. 12% of the audience says A, primary shares. 67% says B, secondary shares. And 21% say both.
All right. This was a little bit of an exercise in short-term memory. I apologize. Secondary shares, right? These, since the owners need the cash, the owners through the holding company mostly need the cash, they're going to sell existing shares, mostly secondary shares, so that the proceeds don't go to Prada SPA, because Prada SPA does not need that money. It goes directly to the holding company or to the bank if the bank participates in the offering, which it did. Okay, so as we will see, mostly secondary shares. You can look at the numbers. These are approximately the number of shares which were issued by Prada in its IPO. New shares, 68 million. Existing shares sold as part of the IPO, 420 million, so this means nothing to you except that it's mostly secondary shares. But I need to tell you how many shares they have to start with. 2.5 billion. So 2.5 billion shares. This means that the family is going to retain about 80% of the shares in Prada SPA. This 80% is kind of a magic number. It has to do with consolidation and taxation. Okay, so mostly a secondary offering, mostly to raise money for the company. As you will see later on, investors were a little bit reluctant to participate in the IPO because they were thinking, why do you do an IPO? You don't need money. You just want to cash out. All right, I want to move to the next topic. This is the technical part of the presentation. Those of you who are experts on company valuation, bear with me. I'm going to talk about mostly two methods, two methodologies for valuing companies. Those of you who are not experts, I'm going to go a little bit fast on this, but this could be the topic of another webinar easily, how to value companies. So how are we going to value Prada in preparation for the IPO? By the way, who's valuing Prada? At this point, not investors, it's Prada's bankers, the bankers who are helping the company prepare for the IPO. From the moment that the IPO is decided, the bankers start preparing valuation exercises for Prada. And these valuation exercises are going to continue throughout the process, which is, by the way, a 6 to 9 month process, taking the company private, from being private, a family-owned business, to being a publicly traded company on the Hong Kong Stock Exchange. And throughout that process, the bankers are going to update their valuation of the company. At first, they're going to use two methods, which we're going to see: trading multiples and discounted cash flow analysis, DCF. And over time, DCF is going to play a lesser role. And as we get closer to the actual IPO, it's going to be more and more about trading multiples and general market conditions. The process of pricing, we're in March, it's still a long time before the IPO. At this point, we're still looking for ballpark numbers, but eventually the bankers will come up with a price range within which they're going to pick the price. And I'll tell you more about this later on when we look at the process. Okay, so bear in mind we're in March, we're going to do a very rough job, and it's a non-binding job. It's just to get an idea of what's the price at which we could sell those Prada shares. Let's start with the trading multiples technique. I'm not going to do full justice to it. I'm just going to go through the main case, the main technique that is used. I'm going to focus on the price-earnings ratio methodology for valuing a company. And the essence of trading multiples is just to say, well, we don't know what is the price of a share of Prada. The reason why we don't know what's the price, what's the value, is that these shares are not traded. There's no price to look up. But what we can do is the same thing we do when we buy an apartment, a flat, depending on which country you are. When we buy an apartment, we just look at similar apartments, and we look at the price per square meter, and then we make up a price for the apartment in question. So we do the same with companies. That's the trading multiples approach. First of all, we find similar companies, comparable companies. Sometimes they're called just comparables or just comps. Here's what Prada's bankers came up with. In fact, they had a longer list, and they kicked out a bunch of firms, and about 10 firms remained. The yellow firms, these are the firms the bankers thought were the most comparable to Prada. Look at the rightmost column. This is where the bankers give a score, if you want, a comparability score for these companies. LVMH, highly comparable. Burberry, highly comparable. Hermes as well, probably even more so. Bulgari, very comparable. Then the companies in green, slightly less comparable because they're less prestigious companies. And then, interestingly, the bankers also came up with companies that are not at all in the luxury, or not much in the luxury business, but that happen to be traded in Asia. These are the 10 comparables. They formed 3 subgroups of these comparables, of these comps. The first one, luxury tier 1, had 4 firms, but very soon they kicked out Hermes and Bulgari. Why? Because these companies there were rumors that these companies were about to be acquired by LVMH, by the way. And as a result, their stock price had increased dramatically in recent weeks, and therefore we could not use their stock price to value Prada. They were distorted stock prices, the bankers believed. So eventually they had 3 groups. The first group, core luxury tier 1, with just 2 companies, LVMH and Burberry. Second comparison group, core luxury tier 2, Richmond, Tiffany, and Tod's. And then the third group, the Asian consumer panel. I'm going to focus today mostly on tier 1 just for the sake of time, but they use all of them. Here's the method, the price to earnings ratio method for valuing Prada. I'm using just one version of this, okay? I've put all the peers on this table, and for each of the peers, we have its stock price, most recent stock price. These are all, of course, publicly traded companies. That's why we can observe their stock prices. We have the number of shares outstanding. We have their net income forecast for 2011. Remember, we're in March, so it's still some months to go. And out of these 3 items, we've been able to compute the PE ratio of each of these companies. So let's take one of them. Let's take Burberry. Its PE ratio, price earnings ratio, at the time was 21.5. In fact, I should say 21.5 times. Its price, stock price, was 21.5 times its earnings per share. How did I come up with this calculation? There it is. I took the earnings for Burberry's, 278 million, divided that with the number of shares that Burberry has outstanding, 431. This gives me the earnings per share for 2011, at least the forecast, 0.6. Next, I took the stock price of Burberry, the latest stock price of Burberry, 13.85, divided that with the earnings per share I just computed, and that ratio was 21.5. Okay, and I can do this for every and each of the comps, and I get a bunch of PE ratios. Now, what do I do with this? Look at this. I took the average, the mean, of all luxury tier 1 comparables. Here there's only 2, so that's easy. But I did the same for the other peer groups. And what do I do with this mean? I use it to value Prada. How do I do this? I take Prada's own earning forecast, 333 million euros for 2011, divide this with the number of shares that Prada has outstanding. Remember, 2.5 billion shares. This ratio gives me the EPS, earnings per share of Prada for 2011, is the forecast. And then I take the peers average, 20.2, multiply it with the EPS of Prada, which I just computed, and this gives me an estimate of the value of one Prada share, 2.7, 2.69 if you want to be precise, 2.69 euros per share. Okay? I can do this for each of the subgroups. I can do this for all the comps together. I can do this for 2011, the forecast, 2012 forecast. I can look back and use the earnings for 2010 if I want. This gives me a cloud of values, and in March, because we're still far away from the IPO, the bankers will continue living with a cloud of points, and that will give them an idea of where the price might lay eventually. Okay? Now, there's one issue with this method. I'd like you to think a little bit about it. Prada, remember, this is where it's very important to to know a little bit about the business, as we did a very fast review of the business, Prada is growing faster than its peers. It's growing faster than LVMH, faster than Burberry's. Why? Because it started later than the others. It's catching up with them. Now, the fact that Prada is growing faster than the peers whose numbers we've used to value the Prada share, I'd like to know what you think this has done to us. Does this mean we have undervalued Prada, or perhaps overvalued Prada, or perhaps neither of those? Think about it for a sec, and then we catch up in a second.
Okay. The poll's been open whilst you're talking, and we'll leave it open for a few more seconds. All right, and closing the poll. Okay, Denis, we have a very convincing response rate. 82% believe A, that Prada's shares have been undervalued. 9% say overvalued, and the remaining 9% say neither.
Okay. Again, I apologize. This is a slight exercise, exercise in mental calculus, very quick mental calculus. So yes, the fact that Prada is growing faster than its peers means that if we use the peers ratio, as we have done, we're going to undervalue Prada. Why is that? Well, think about it. For every euro of earnings, Prada is going to get much more earnings in the future than its peers. And this ought to be reflected in the value of the shares of Prada today. So every euro of earning is promising, in a way, much more earnings in the future for Prada than for its peers. So if we use the peers valuation per euro of earnings, we're underestimating Prada. In fact, for that reason, because Prada is growing faster than its peers, the bankers decided to add a premium to their calculations. They said, okay, based on the peers, it's about 2.7 euros per share, but because Prada is growing faster, and also, by the way, because Prada is going to be traded on Hong Kong, and the Hong Kong market is hot, we're going to add a 20% premium to that number so that we don't penalize Prada, who is growing faster than its peers. With a 20% premium, the value is higher than 3 euros. It's 2.2, 2.3 euros. Sorry, 3.2, 3.3 euros. Okay? What does it mean? It means that all of the equity of Prada, which is, remember, 95% owned by the Prada family, is worth north of 8 billion as per this calculation. I do that in your head, 95% of 8 billion to be divided between 4 people, that's not too bad. Okay, so that's the calculation. Of course, with this technique, I've used just one number. There are other ratios that we can use, enterprise value to EBITDA, and indeed, the bankers use that ratio as well. We can use ratios which are corrected for growth. This is not very widely used, but the bankers did that at least in March in their calculations, and this adds just more numbers that come to inform the valuation by the bankers.
Denis, before we move on, Pascal is wondering why the 20% figure is being used.
Why the 20% premium, right?
Yes, yes.
For the reason that we have just discussed. Remember, this 2.69 euros, this is the valuation of one share of Prada that we have derived from a comparison of Prada directly with its peers, using the peers' price to earnings ratio. But Prada is growing much faster than the peers. So the value for each euro of earnings is going to generate much more future euros of earnings than its peers. For that reason, the value of its shares today should be higher per euro of earnings, because the future looks much brighter per euro of earnings for Prada than for its peers. That's the reason for the 20%. Now, if the question is why 20% and not 12%, which is probably your question, that's just a fudge factor. At this point, the bankers come up with this number. It's not binding for anyone. They're just thinking later on, I'll show you the process, later on when they try to market the IPO, when they try to sell the shares to investors, they're going to make that argument. Look, if we look at the peers, Prada should be worth 2.7, but in fact they're growing faster. We should have a premium, and we think 20% reasonable. Then the investors will come back and say, why 20%? So let's do 13%. Okay, that's just at this point, it's just a ballpark number. We'll see that in the end whether the bankers were right or wrong in thinking they could sell the shares to investors at this premium. Okay, let me move to the second technique, discounted cash flow analysis. This is very different in nature. This technique takes the business plan that Prada had to produce for the next 3 years, plus some projections for an extra 3 years, and on that basis, forecasts the future cash flows generated by Prada's assets, and determines their value today, very importantly, accounting for time and risk. Cash flows in the future, cash flows that are risky. Just to think about it. Remember, Prada is going to generate some cash flows in year 1, 2, 3, 10, 20. We need to think about how to value cash flows that are going to arrive in the future. So just to think about it, which is worth more? $1 million today or $1 million next year? Or maybe neither, maybe they're equally appealing.
Okay, the poll is open and the votes are coming in. Leave it open for about 8 more seconds. All right, and closing the poll, thank you. So Denis, 77% say $1 million is worth more today, 14% say next year, and 9% say neither.
All right. Okay, so let me give you the textbook answer. The textbook answer is $1 million today. Why? Because you could take that $1 million, invest it, and then 1 year later, receive your $1 million back plus some interest. Okay, so $1 million today is more appealing than $1 million to be received next year. This is very important to understand the valuation technique. Later cash flows are worth less than earlier cash flows, and that's going to be reflected in the technique. The other thing that's going to be reflected in the technique is that riskier cash flows are going to be worth less than safer cash flows. How do we deal with those two concepts, which are very, very important in finance? Timing and risk. Broadly speaking, this is how we do it. We use what is called a discount rate. This discount rate is a number. I'll show you a number in a sec. It's 9% in the case of Prada. It's a discount rate that is used to, quote unquote, penalize cash flows according to how risky they are and how late they arrive. Now, for a company like Prada, a very, very widely spread simplification is to assume that all of Prada's cash flows are equally risky. This is the aggregation of many, many small projects that generate those cash flows that are equally risky. But of course, they arrive at different times. So what do? We take the cash flow to arrive in a given year, n years from now, and we multiply it by 1 over 1 plus a discount rate, in the case of Prada, 9%. And this 1 plus the discount rate is taken to the power of n, the number of years before the cash flow arrives. As you can see, we're multiplying a cash flow by a number that is less than 1. And the larger n is, the smaller is that factor, that discount factor. Okay? This is going to penalize more cash flows that are later in the future. The discount rate captures the risk of the cash flows. The N captures the impact of time. Now, how do we come up with the discount rate? Again, this would be the topic for another webinar for sure. Essentially by using data from the peers of Prada who are already publicly traded, and then unbiasing this data, adjusting this data to Prada. Long story short, we come up with a discount rate, which is usually called the weighted average cost of capital for Prada. And that number happens to be 9% in the case of Prada. I'm just giving it to you. In principle, we could derive it using the data that's in the case. What do we do with this? Top line, I have projected, this is the bold numbers in bold face. I've projected the cash flows of Prada for the next 6 years. Line below that, I have the discount factor which I'm going to apply to these cash flows. Notice that the discount factor is smaller for cash flows further into the future. The product of the cash flow and its discount factor year by year is the third line. That's the present value of the cash flows to arrive in the future. And then the last number, this 2.1 billion euros, this is the sum of all these present values. It's the value today of these 6 cash flows to be received in the next 6 years. Aha, 2 billion. That's that's much less than what we estimated using the PE ratio. We estimated about 8 billion, and here we have only 2 billion. How come? Because we haven't looked at the cash flows beyond 2016. There's a lot of cash flows to come after 2016, assuming Prada survives until then. How do we value those? In practice, this is very important because in practice, a lot of the value of the company corresponds or comes from those cash flows that arrive far into the future. We'll see that in the case of Prada, it's basically 3/4 of the value. How do we deal with this? There's different techniques. Here I've presented the absolutely simplest, not very robust version of that. I'm assuming that the cash flow in 2016 is going to grow at a constant growth rate forever, on average. What is the value of an infinite series of cash flows growing at a constant rate? That's given by the formula I've just put on the slide. Again, we could spend more time trying to understand where this comes from. Let me just move ahead in this case. And with Prada, we find that the terminal value, applying the formula I just used, that's the number that's far on the right, that's 12 billion. 12 billion euros, that's much more than the 8 billion euros we've estimated before. Oh yes, but that's 12 billion euros of 2016. Remember, values in the future or cash flows in the future are worth less than cash flows today, so we need to apply a discount rate to these 12 billion to bring them to the present, and the present value of that terminal value, the PV of the TB, is the 7.1 billion at the on the left-hand side of the slide. Okay. How did I come up with the terminal value? As I said, 9% discount rate, and I've assumed a growth rate of 2.5%. What do I do next? I take the sum of the present values of the next 6 years, and I add that with the present value of the terminal value. That gives me this 9.3 billion euros, and that's the value of Prada. Wait, that's the value of Prada's operating assets. Operating assets, these are the plants, the brands, the people, and so on. 9.3 billion. Prada has more assets than this. It has some cash. That has value. We haven't counted that. But also wait, Prada not only has cash, but it also has some debts. And if we're trying to value Prada's equity, we should subtract the value of the assets that debt holders are going to get. We need to take what is called the value bridge that goes from the enterprise value that we've just estimated using DCF all the way to the equity value of Prada. And how do we do this? First of all, by completing the assets, not only the operating assets as in enterprise value, but add the cash and the equivalents to cash. And once we have completed the value of all the assets of Prada, we need to subtract Prada's debt to get to the equity value. And that's what I did on the next slide. And now we're done. We have the enterprise value, we add the cash, that's the 116.3 million euros. We subtract the debt, long-term debt and short-term debt, and we get to 8.9, almost 9 billion in equity value before the IPO. Divide with the number of shares, that's 3.6, and here we are, very close to the estimate we had using the PE ratio and the 20% premium. Now, why don't we apply the 20% here? Well, remember, the reason for the 20% is that Prada is growing faster than its peers, but the growth rate of Prada is already reflected in those projections, so we've already taken that into account. No need to up this by 20%. Okay, bottom line, we have two methods. They give us, not the exact same number, but broadly speaking, similar numbers around 3.3 to 3.6 euros per share. Again, the bankers would not stop here. They would do some sensitivity analysis. They would use a couple of other methods, but basically that's what they would do. Okay? So we've seen two techniques for valuing the company.
Denis, we have a question from Jean-Louis asking about how the calculation for terminal G of 2.5% was done.
Yes, so very, very good question. In fact, this is frequently asked questions. It's a very important one. How is the 2.5 estimated, 2.5% estimated? The answer is with great difficulty. It's a very important number because it has a very big impact on the value of the company, on the estimate. There's some rules of thumb that people use. The number should not be too small, otherwise you're assuming that the company is shrinking. The number should not be too high. For instance, it should not be higher than the growth rate of the economy, because otherwise you're assuming that the company is growing on average faster than the economy, meaning that the company is going to become the economy. The lower bound is usually the inflation rate, and upper bound the growth rate of the economy. In the case of Prada, it depends which economy we're talking about. A lot of it is going to come from, a lot of the growth going to come from Asia, so perhaps higher growth. It's more art than science, I have to confess. All right. Okay, let me conclude with a few minutes we have left with the process of the IPO. This is going to go very fast because there's not that much conceptually to contribute here. It's more a description of how the IPO worked. First of all, Prada recruited a number of banks. 4 banks mostly: UniCredit, Banque AMI, Crédit Agricole, or its Hong Kong operation, CLSA, and Goldman Sachs. These were the banks that were going to organize the IPO for Prada. And then there was also a Chinese bank and a Japanese bank to help with the distribution of the shares, as I will show later on. What did the banks do? Let me not go into details. Essentially, they do a lot of things. They prepare the company on all sorts of fronts to change from the status of a family business, an Italian family business, I should say, all the way to being a publicly traded company in Hong Kong. Being publicly traded implies a lot of regulatory hurdles, a lot of scrutiny, a lot of compliance. And so the bankers do all sorts of things. They prepare the structure of the company, they simplify the structure, they make sure the roles of every member of the leadership is clarified, they produce accounting, numbers for the last 3 years, as if the company had been public for the last 3 years, etc., etc., etc. They do a lot of regulatory documentation. They decide, with the company, how many primary shares, how many secondary shares, etc., etc. One thing that they do is that they prepare what is called the equity story, which is essentially a broad description of what is the company about and why it does the IPO. And this is going to coordinate a lot of the communication around the IPO. Then, analysts of the banks, in this case, the analysts of Crédit Agricole, go around the world and meet a bunch of investors. These particular two analysts met about 300 investors over the course of 1 month in the main financial centers of the world. When I say investors, it's not you or I. These investors are actually institutional investors. These are mutual funds, pension funds, insurance companies, etc. Sovereign wealth funds, etc. They present the IPO and they get feedback from the investors. I was lucky enough to get the feedback that the banks have received, at least that Crédit Agricole received. And there's just one thing I want to point out. If you look at the key concerns, bullet number 3, the investors ask them, why do you want our money? You don't need money, so why an IPO? Bullet point number 6, which turned out to be an important one, Italian taxes. Investors in Hong Kong, it turns out, would have to pay taxes on capital gains in Italy. So you're a Hong Kong investor, you have to fill your taxes in Italy. That was a big problem. Next step, the roadshow, the management team. So a lot of the key members of the management team, as you can see, Patrizio Bertelli, as well as his colleagues, go on a tour, and the tour is, they are coached by the banks, if you want. And meanwhile, so they go on a tour around the world, meet investors, drum up interest for the IPO. This is getting closer and closer to the IPO. Look, it's June 6 to June 17, 2011. We're very, very close to the IPO. Meet hundreds of investors, 100 investors in one-on-one, so just management and one investor, maybe Prudential, for instance, and then some larger meetings with other investors. In the meantime, the banks are collecting expressions of interest from the investors. They're doing what is called the book building. What does it mean? It means that every investor that they meet says how many shares they would want to buy if the price was X, and how many shares they would want to buy if the price was Y. Okay? And they collect these demands, and the collection of these demands is called the book. This is a picture of the book as it was evolving through the days in June. As you can see, the dark blue bar is the number of shares, the amount of dollars that would be raised, that investors would want to pay in total if the offer price was 48 Hong Kong dollars. You can find the 48 just below the graph. The yellow bar is the additional demand that would come from investors if the price was only 39.5. And then the light blue is the additional demand if the stock price, the offer price was 36.5. And you can see from one day to the next, these bars are increasing, meaning that essentially the bankers are meeting more and more investors, and these investors are adding their demand to the book. Incidentally, the whole offer, the number of shares has been set a long time ago. The whole offer is easily sold on day one. Doesn't mean that it is actually sold, but there's more demand than supply already on day one, but the book building continues until the last day. Now, true to style, you can see that towards the very end of the book building process, suddenly the process hits some problem, some trouble. What is it? The Greek crisis. No, not again. First, 9/11, 2 IPOs canceled. Next, the financial crisis, 2007, 2008, 2 IPOs canceled. And now the Greek crisis, investors are withdrawing their demands, their orders. Still, the bankers push ahead, they lower the price towards the end of the range, and the IPO goes through. The price is set at 39.5 Hong Kong dollars. The allocation is done. You have the breakdown by geography, you have the breakdown by type of investors. An international offer, long-only investors mean these are essentially institutional investors who don't short sell stocks as opposed to hedge funds that can short sell stocks. So mostly long-only investors. And you have here anonymized the list of the top investors who received shares in the company. If you think that an IPO results in the company being held, like Prada being held by you and I, not at all. You can see that 49% of the issue is held by 10 funds. Okay, not very dispersed ownership. Okay, and not retail investors. Retail investors, very, very small. 5% in the case of Prada. What about the price? This is hard to read, but essentially this is a slide by the bank, by Crédit Agricole, saying, look, yes, we managed to sell the shares at a 15% premium to the peers. We delivered on our promise of a premium. Perhaps not on the 20% premium, but close enough. That's about 3.7 euros per share. Bizarrely close to our estimates, I would say. Okay, last slide. What happened since then? Well, at first everything was going well, and then things went not so well for a long time. And interestingly, one of the key things that hit Prada as well as the other Western luxury companies is China's crackdown on corruption. Partly, this is a very big hit to luxury firms. The stock price eventually fell to 40% below the IPO. So in retrospect, it was a great idea to do the IPO because the shares were sold at a much higher price than what they were trading at eventually. And of course, more recently, if you've read the press about Prada and luxury firms, there's been a very important rebound in their fate. Okay, that's what I wanted to say about the IPO of Prada. Thank you.
And we have 3 or 4 very good questions. We'll run through them and we'll let everyone get on their way. Question 1 coming in from Mariam. Mariam would like to understand if when doing the valuation, should Prada be compared to only those currently on the stock exchange or not necessarily?
Yes, so the method for valuing a private company is to look at the price of comparable firms. Now, for comparable firms, how do we find the price? Well, we find the price of those comparable firms whose stock is traded. That's why the method of choice is to look at publicly traded comparables. And as you noticed, in the list of comparables that I used for the valuation, all of those comparables were publicly traded exactly for that reason, because we need their stock price as part of the method for valuing Prada.
Okay, great, thank you. Great, yeah, great question for those who are coming in different levels there. So a great, I'm going to ask a 2-part question, courtesy of Matthias and Vanita. Matthias would like to understand why was the IPO chosen to be done on the Hong Kong Stock Exchange? And the follow-up from Vanita is, what are the advantages of them having done so in the Hong Kong Stock Exchange, aside from the hot, luxury market in Asia?
I think if you ask in the preparation for the IPO, the management of Prada said we want to be where our future clientele is, basically where our growth is. We're a global company. A lot of the demand in the future is going to come from the increasingly affluent Chinese middle and upper middle class. That's where we want to be. So they say, we want to be close to our customers. Another way of phrasing this is the IPO has also a marketing aspect to it. When I say marketing, I don't mean marketing of the shares. Of course, that's a very big part of the IPO. But once the company is public, during the going public, the company is on the news a lot. And then after it's public, it's also on the news because the stock is traded on the Hong Kong Stock Exchange. Now, that's what the management said. What the bankers said is currently, prices on the Hong Kong Stock Exchange are higher than elsewhere, particularly for these type of companies. Now, perhaps for the bank industry, this is not a very surprising statement, but for a finance professor, this is a little bit surprising. Why would the price be higher here than there for the same type of company? And I think here the answer is that there's a lot of capital that is stuck in China that cannot move away from China very easily, that can go to Hong Kong to invest in Prada. So to answer the question, to summarize my answer, 2 reasons. One is related to the business itself. A lot of the growth they hope is going to come from China. That's the main challenge, catching up in China, and not only in the very, very top cities, but also in the second tier cities. This is one of the big challenges for luxury firms, and in particular for Prada, that was lagging its peers in that respect. A lot of operational risk involved there. And number 2, valuations higher in Hong Kong, on the Hong Kong Stock Exchange.
Okay, great, thank you. The next question is coming from Amita. Regarding the expanded equity base, she'd like to understand how sound is a luxury segment, considering that there's a major dependence on China for purchases. And following that, she'd like to understand what future measures would they take to maintain share price?
So, so as an investor, I think I understand the question like this. As an investor, is it a good idea to invest in Prada? Well, in retrospect, not a great idea, because eventually the stock price declined quite dramatically, mostly because of factors that were not under Prada's control. Crackdown on corruption, slowdown of the Chinese economy, slowdown, still growing, but not growing as fast as before. Slowdown in Europe as well. So all of these things were outside Prada's control. I think by and large, the proposition is a sound one. There's demand coming from China. Some of the dangers for luxury is probably development of local brands. This is happening. We know this is happening. So there's a bit of a race between existing brands and local brands. I think these are the main challenges, but I don't think this is something, as an investor, this is, of course, the session today is about the corporate finance of the IPO, but if you're thinking about the portfolio side, as from the investor's viewpoint, I think most investors would want to invest in Prada at that point, mostly to get exposure to China, to the ups and downs, for portfolio diversification, more than for making a good deal per se. I think that's the big thing.
Okay, great. We'll take the final 2 questions and then wrap things up here. From David, these 2 questions are focusing on the calculations done for the IPO. David would like to understand, or he feels that a peer group of 2, given you show how others were kicked out, is a rather small sample, and he'd like to understand whether or not this introduces known or unknown sample risk.
Yes. Again, I didn't do full justice to the exercise that the bankers did at the time, but you're right. Eventually, they priced Prada based on 8 comps. That's a small sample. And out of these 8 comps, 3 of them are not luxury firms. So 5 comps. Yes, that's a big problem, but if you think about it, that's kind of a problem inherent to that industry. Each of these firms, at least each of them will claim, It's quite unique. So, and by the way, there's a fair amount of there are two things that play against the valuation of Prada with multiples here. One of them is that there's a lot of consolidation in that industry. And remember, two firms were kicked out because they were perhaps being acquired by LVMH. So that's one thing. The other thing is that there's a non-negligible number of luxury firms that are still private firms. Private in the sense that they are not publicly traded. They're not traded on stock exchange. They are like Prada before the IPO. We cannot use those, as per the answer to a previous question, we cannot use those in the multiples method. So in this case, I think the exercise had to rely on a limited number of comparables. That was a constraint on the exercise. That's true. And I think, broadly speaking, people conducting such an exercise will be cognizant of that. They will realize that, yeah, it's a small number of peers. And by the way, they're not super comparable to Prada because these are not standardized, surely not commoditized items. And the mix of products is very different from one company to the next. Some of them are more focused on leather goods, others more on jewelry, which Prada doesn't do at all, etc. So they'll realize that there's a lot of noise in the estimate, to use a technical term. So they know that valuing a company is actually you cannot do a very precise job. On that point, I don't want to belabor this point too much, but on that point, the fact that you cannot do a very precise job valuing a company is not a sign that the tools are bad. It's a sign that the question is very difficult. So even blunt tools are very, very useful, because without tools, you're completely lost. So with tools, even blunt ones, you narrow down the uncertainty a lot. Even if the remaining uncertainty is large, what you've eliminated is even bigger.
All right, and here's the final question from Petros. Petros would like to understand what percentage of the enterprise value should terminal value be in order for the DCF model to be appropriate?
There's no recipe for this. Let me say what practitioners do. They do a job sector by sector. They know that in slow growth sectors, terminal value is almost always at least 50%. But practitioners with experience will know that in sector X, if it's more than 90%, then we need to look at the numbers again, perhaps extend the period over which we do explicit forecasts to make sure that we're not excessively dependent on terminal value estimates for our value estimate. But they'll know that in some other sectors, imagine a sector that is loss-making now. You're valuing maybe a startup or a company that's in an industry that's in a big investment phase. Well, they're making investments today because they think there will be profits in the future. A lot of the value, perhaps more than 100%, is going to be in the terminal value. So this varies, to answer your question, this varies a lot from sector to sector, and experienced professionals have a sense for what is reasonable sector by sector, essentially. And then they apply a smell test, sector by sector, to say, okay, 75%, that sounds reasonable. 90%, let's look at the numbers again. And I'll pass the mic to my colleague, Miranda. And then later on, we'll take more questions if you want.
Okay. Thank you very much, Denis, for a great presentation. Hello, everyone. Thank you for joining us today, and I really hope you enjoyed this wonderful webinar that we've just been treated to. I just wanted to say a few words today about the Executive Masters in Finance at HEC Paris. So Denis Gromb is one of the faculty members for this program, It may be that you've tuned in today because you are particularly interested in updating your knowledge and skills in finance. So a little bit about the program. First of all, a little bit about HEC, just to give you some background. You probably have heard of the institution, but just in case you haven't. The school was founded in 1881, so this makes it one of the oldest business schools in the world, certainly one of the oldest schools in Europe. We quite impressively have more CEOs who have graduated from HEC Paris than any other business school in the world, and I think over the years that has really enhanced our reputation and given a great showcase for the sort of teaching that goes on here. We were recently ranked 6th by the Financial Times in the entire world for our teaching and executive education, and 3rd for our pre-experienced master's programs, so slightly younger candidates there. We have 57,000 alumni around the world, certainly not just in France, not just in Europe. It's a truly international community of alumni spread across 132 countries. So that's a bit of background about the school. The Executive Masters in Finance, who is it for? Well, you'll see from these photographs here, it's for people who already have some sort of background in this subject. So maybe you are a finance director or a financial manager in a private company, a deputy CFO, a future candidate for a CFO role. You could be working within a commercial bank and interested in gaining further insights into the world of investment. We also have consultants on the program, general managers from companies. So a wide range of backgrounds, but the key thing is you've already done things in your career, you've had some exposure to financial topics. So that's our typical participant. 39 years old is the average participant on the program, with around 15 years of experience. The program is a fully fledged MSc, so even though it's modular, and in that sense it's part-time, so you continue working whilst you take the program over 18 months, what you end up with is a fully fledged Master of Science in Finance. So exactly the same content, academically speaking, as an 8 to 10 month program in the UK, for instance, or a full-time program in the US. So just going a bit more into the content, it's designed to give you a fully rounded view of the subject. So building from corporate finance fundamentals, you can see there in Module 1. You are also integrating some macro level subjects into the curriculum, strategic and operational considerations. So we're not just staying in that very focused micro level or quantitative view of finance. You're really being encouraged to think about financial topics from a senior management perspective. So it's all about enhancing your ability to be able to make financial decisions in the upper rungs of a private company, whether that's in the banking sector or not. We aim to address a very wide range of sectors. So those are the 5 modules over 18 months. So they're 8-day modules. So it's enough time to get really absorbed into the content of each block of the program, but then you have nice spaces in between the modules to go back home, take care of your professional life, and keep on track with that, complete the assignments in between the modules. So our participants generally find it's a good balance. How to be considered for this program. So I mentioned a few key statistics about the typical participant. So you will need around 8 years of experience as a minimum in the sorts of backgrounds that were listed a few slides earlier. We do an initial assessment through an interview. So it's a preliminary interview. It's what we call an informational interview, so it's for you to ask questions as well. And through this, we will assess your potential for the program. and give you feedback on that. If we encourage you to move further in the application process, then there is an online application form to fill in. And then the final step, as you would probably expect, is a selection interview with the academic director of the program. So going into a lot more focus in terms of actual academic content and your engagement with those topics. So face-to-face teaching begins for this program in October. We have one intake per year. So you'd be sat in class in October. Prior to that, in September, you have the option to complete a number of refresher modules. So these are basically online courses. If you're wondering whether your finance skills are up to scratch or whether you would be ready to start on this kind of program, we make sure that we're bringing everyone up to a certain level before they're actually walking into the classroom. If you want to engage a bit more with the type of taught content that you might experience on this program, obviously today's been a great example of that. We do have a face-to-face masterclass happening in Paris on the 30th of May. And if you go to the HEC website and navigate to the page for this program, and I'll give you the URL for that in just a minute, you'll be able to sign up for this event. So you can register online for this and attend the masterclass and see if you are interested in the program and would like to continue considering it and being considered for the admissions process. So the quickest way to either be considered for the program or to attend another event, for example, the masterclass I just mentioned, if you go to the HEC website and navigate to executive programs, executive master's programs, and then click on the link to the executive master's in finance. That's where you'll find all the relevant information. We have program advisors here at HEC for initial questions if there are things that you're not sure about. If you want to find out a bit more before, for example, submitting a preliminary form online, then you can get in contact with a program advisor. For this program, that would be my colleague Jean-Bernard Tisson, and his contact details are there in front of you. And we aim to get back to people very quickly. So please don't hesitate to do that. And that's everything I had to say today. So thank you for your attention.
Okay, great. Thank you so much, Denis, for a really great presentation. Even I, as a layperson, walked away with some takeaways and further knowledge, so compliments to you. So we thank you for this partnership between HEC Paris and IB Exec. We appreciate your time and attendance. All of you hung out with us for this Q&A section. We hope you got a lot of value out of it and hope to see you in future. Denis, I'll turn it over to you for any final words to the audience, and we thank you for all you've done.
Just wanted to thank you all for your attention. I know this setup is we cannot interact directly that much, although we had a good Q&A session. If you have more questions, feel free by all means to write to me and about the case or about the program. It's a very exciting program. We're very proud of it here. And as I said, this case is being taught in that program, but there's a bunch of other cases obviously that we touch upon that have to do with restructuring, in particular in that course.
Wonderful. And Denis, and that email address, I'm going to type it into the chat box. Everyone, into Gromb, Gromb at hec.fr. And that's in the, oh, sorry, I need to do that into the everyone, not just organizers. One moment, please. Okay, everyone, there's the email address. I'll leave it there for a few moments, gromb at hec.fr. And so thank you very much, Denis. Oh, there it is on the screen too. So with our powers combined, we're informing everyone. All right, then take care. Have a good evening, good afternoon, or good morning, depending on where you are. And hope to see you in future for future collaborations with HEC and IB Exec. Take care.
Bye-bye.